Top news headlines are often dominated by the release of gross domestic product figures, and for good reason. GDP releases attract a lot of attention from traders and market participants because of its signaling effect and ability to move financial markets. Growth and GDP go hand in hand and are often used interchangeably. GDP measures the value of goods and services produced by a country in a given year and serves as an indication of economic health of that country. Essentially, it's an objective measure of improving or worsening economic conditions in a particular country over time. GDP has four main readings, one per quarter, often denoted as Q1, Q2, Q3, and Q4, with three readings per quarter, the advanced figure, the second estimate, and lastly, the final figure. These figures are released whenever new information about the economy for the quarter in question becomes available. This is why you may notice that GDP figures are reported every month. However, from a trading perspective, the very first figure often carries the most weight as subsequent figures do not differ too much. As a result, GDP is known as a lagging economic indicator, which means there is a lag period before the data is collected, analyzed, and adjusted to account for seasonal influences. The U.S. Bureau of Economic Analysis also provides real GDP data that eliminates the effect that inflation has on the total value of goods and services produced in the economy. This reading is useful because inflation, in the form of higher prices, can artificially boost nominal GDP readings. This may result in perceived levels of output that are greater than what exists in reality. GDP figures can also provide a signaling effect as the broader market anticipates fiscal and monetary responses to different economic conditions. When economic growth is stagnant or the economy is technically in a recession, central bank policy shifts and becomes more accommodative, providing liquidity and lowering interest rates, while increased government spending often follows suit. Traders and investors then tend to shift out of interest-related investments in search of higher yields elsewhere. In economic booms, central bankers look to rein in overheating economies, and monetary policy becomes more contractionary in nature by raising interest rates, while governments often reduce spending. As a result, interest-bearing investments like bonds or money market funds start to become more attractive investment options. The same logic can be applied to the Forex market. Currencies linked to central banks that are dovish tend to depreciate at the start of an interest rate cutting cycle, shown here with the US dollar index alongside the US federal funds rate, while currencies linked to central banks that are hawkish tend to appreciate at the start of an interest rate hiking cycle. For equities, lower future interest rates make it easier for individuals and institutions to access credit at low rates, which can be used to invest in the stock market. GDP growth is not the only indication of the performance of an economy. While GDP is inherently lagging in nature, traders can consider a whole host of leading economic indicators that can provide insight into the condition of various sectors of the economy before the GDP data is even released. New building permits and the house price index are great indicators of current economic conditions because investing in a house or office building is a long-term commitment that people usually only make if they feel optimistic about the economy. Rising figures are said to be indicative of good economic conditions, while falling figures tend to indicate economic uncertainty or pessimism. Consumer credit. This figure has strong ties to consumer spending and confidence. Rising debt levels are usually indicative of economic strength as banks feel comfortable issuing approving lines of credit and consumers feel financially stable enough to make the monthly repayments. Retail sales, considered a primary gauge of consumer spending, which accounts for a sizable portion of overall economic activity. Consumer confidence. This measures the level of consumer confidence with respect to economic activity. It is a leading indicator due to its association with consumer spending, which plays a major role in overall economic activity. Higher readings point to higher consumer optimism and improved economic conditions.